Thank you very much. Bankers are not accustomed to applause, so I appreciate that. Thanks for having me today. When Lee and the Pulse team invited me to speak today about the local economy, I was honored, of course, and excited to be here. But I gave them the disclaimer. One, I'm not an economist, and two, I'm not a very good speaker. And three, I don't know any magic tricks. But Lee said they got that covered with the magic, so he wanted me to do it anyway. So thanks, Lee, I appreciate it. So let's get right into it. Maybe. I'm going to talk today about the recovery, rates, capital, and confidence. We are in an economic recovery, although it is the weakest recovery of the post-World War II era. We're in a period of historically low interest rates. They should remain low for at least 2 more years, we think. We have abundant capital available and sitting on the sidelines. Business confidence is cautiously optimistic. And consumers are optimistic, but they're broke. Slow and steady recovery. We're now 4.5 years plus into this economic recovery, but we're finally starting to see some positive signs of locally. We're seeing some revenue growth, improving profitability, job stabilization, and renewed capital investment. However, there's still a lot of uncertainty around tax rates, healthcare costs, the political environment, regulations. All of these things are still holding business owners back from investing and borrowing more than maybe they would otherwise. You know, Citizens Bank's been ingrained in this community since 1957. We really do know that we have a pulse on the economic condition of our community. We're fortunate to have a broad base of business customers touching a lot of different industries. And this is what we're seeing. In 2013, we're seeing pretty much across the board improvement in financial condition. The agricultural business, grass seed farmers in particular, they're finally moving some inventories that they've been stockpiling for the last couple of years. Prices are improving. Manufacturing companies are seeing good revenue growth, production backlogs, especially in automation-related equipment. In the timber industry, mills are building inventories again, so loggers are back in the woods. Log prices are good, and we're seeing log trucks back on the roads here locally. That's always a good sign. Government and education. This is one sector that really is recession-proof, it seems. We already heard from David about the strong economic contribution we enjoy from OSU. We really are fortunate to have such an economic stabilizer right here in our backyard. A lot of communities don't have that luxury. The healthcare industry. The Affordable Care Act has been a significant economic stimulator for the healthcare industry. We are seeing substantial new investment in people, equipment, technology, infrastructure, and we expect that to continue through 2014 and 15. Corvallis area restaurants and bars, they are really doing well. Many reported their best years ever in 2013. And you can see that if you come downtown on the weekend and look for a parking spot, it's hard to find. Retailers, however, continue to struggle. Most are reporting revenues that are flat or even down. And certainly they're down from the pre-recession levels. Consumer spending is down, and many retailers report that online competition is making it really tough on them. Real estate activity, both residential and commercial, is up. We'll hear from Rhonda later, and she's going to share more about that, but we are seeing quite a bit of new construction activity and inventories being absorbed, and it's exciting to see cranes downtown and things of that nature. Now, nationally, we are seeing improved small business earnings. The National Federation of Independent Business surveys small businesses across the country. This slide illustrates the big drop in earnings in 2009, as you would expect, and the sort of the slow, steady climb out of that hole in the following years. But note that earnings are still below those pre-recession levels nationwide. Now, this graph illustrates how weak the current recovery has been relative to all other post-recession recoveries. I see the blue line up there is the post-war recession average recovery. That's sort of our normal recovery period is indicated by the blue line. The red line is our current recovery. As you can see, in the 48 months that we've been in recovery, GDP has risen about half as much as in average recoveries. Citizens Bank. Now, I mentioned earlier that there's an abundance of capital sitting on the sidelines. Where is it, you might be asking? Well, it's in commercial banks and credit unions across the country. Take a look at this slide. This is Citizens Bank, one little bank in Corvallis, Oregon. And you'll see the green bars represent our loan portfolio over time. Blue bars is our deposit portfolio. And the gold bar going across the top is just simply a ratio of loans to deposits. Now, the banking business is really a simple business. You know, we bring in deposits from our communities, and we turn around and loan those dollars back out into our communities, and hopefully there's a little bit of margin in there for the bank to make a little money. And the sweet spot for banks is about a 90% loan-to-deposit ratio. That's where we like to be. And you'll see in 2004, 2005, 2006, we were right there. We were about 90% loan-to-deposit. We had balanced growth in our loan portfolio and our deposit portfolio. And then, starting in about 2007, 2008, loan growth started outpacing deposit growth. And this phenomenon was happening all across the country. We were loaning more dollars out than bringing in. We became fairly highly leveraged. 2008, we were 106% loan-to-deposit ratio. Again, this was happening across the country. 2008, you'll recall, that is when the liquidity crisis hit the markets. Financial markets collapsed. We had all kinds of problems, and it thrust us into the Great Recession of 2008, 2009. Following that period, following the crash of the markets, businesses did a very good job of deleveraging their balance sheets. They started paying down debt, accumulating cash. Loan demand went away, essentially. And so you'll see our loan portfolio actually started to decrease for the next couple of years following that. And the deposit portfolio skyrocketed, took off. So we're seeing more cash accumulated, less borrowing, more debt being paid down. Now, the result of that, as of the end of 2013, we had $315 million in loans outstanding, but we had $440 million in deposits at the bank. That means we have about $125 million in excess cash that we are eager to deploy in loans. We want to get that money out there, working for our community. So what do we do with that excess cash until loan demand starts to pick up? Well, we park it with our bank, the Federal Reserve Bank. Now, this is my favorite slide, and it's even more impressive to see it on this great big screen here. It tells the story of how massive the Federal Reserve Bank has become since the recession began through its monetary policy initiatives. You've all heard of quantitative easing 1, 2, and 3, I'm sure. Well, this is a picture of that. Now, don't try to read the text. It's way too small. But you'll look at the growth. This is where the recession started, right here, this line. Prior to that, the Federal Reserve Bank had assets of about 800 billion, 900 billion. They were right in there, real consistent for the last, for many years prior to the recession. I should back up a little bit. This is a picture of the Fed's balance sheet. Assets are on top, liabilities are on the bottom. Now, our $125 million in excess cash, along with excess cash for every other bank in the country, is represented right here in this gray area. This is Fed funds overnight deposits of banks like ours. And you can see that's a pretty big number. It's about $3 trillion that's sitting with the Fed. Now, the Fed's using those dollars to implement their monetary policy initiatives. I'll run through the areas of the balance sheet here. This is, like I said, this is Fed funds, deposits of banks. This green area, this is all currency in circulation. So that $5 bill you have in your pocket, it says Federal Reserve note right across the top. That's an IOU from the Federal Reserve. They owe you $5. We're moving up to the asset side. This darker blue section here, these are treasuries. Treasury bonds primarily purchased from the Treasury Department to help stimulate the economy. This section up here, this is all mortgage-backed securities. Fed implemented QE3, quantitative easing 3. It allowed them to purchase $85 billion a month in mortgage backs and treasuries. And they do that to stimulate the economy and to keep the housing market moving, stimulated. Now you'll recall, after the real estate crash, that those mortgage-backed securities really were considered toxic assets, or at least high-risk assets. So the only one in the marketplace that were buying mortgages from Fannie Mae and Freddie Mac is the Federal Reserve. And so that's really been the impetus for keeping mortgage rates low and keeping the market moving forward and stimulated. It's been the Federal Reserve activity. And this slide's a little bit dated. This is as of 2012. December of 2013, the Federal Reserve assets grew to $4 trillion. So in about 5 years' time, they've grown from less than $1 trillion to $5 trillion in size. So it's pretty awesome when you really think of the impact that that's having on our economy. Keep an eye on the Federal Reserve. Their activities, as they continue to taper those purchase activities, will have an impact on interest rates and inflation. One benefit I should mention of this massive growth is that the Fed is generating enormous profits right now. They're generating about $80 billion a year that's remitted right back to the Treasury. So that's supplementing our tax dollars. Historically low interest rates. A Fed study indicates that short-term rates are not likely to begin rising until 2015. There's a lot of pressure on the Fed to keep rates low until our economy starts really taking off. Key data that the Fed's monitoring include unemployment rates, labor force participation rate, and payroll growth. There are some other factors that they're looking at, but there's some real targets set for those numbers. Now, just as a tangent, let's take a look at the unemployment and labor force participation rates. On the left side is Oregon's unemployment rate. U3, the official unemployment rate, is the blue line, and it uses the left y-axis. So you'll see Oregon has roughly 7% official unemployment. Now, the red line is the U6 unemployment. U6 includes all unemployed, plus those are underemployed, such as people working part-time but really want to be working full-time. Now, our U6 unemployment is about 16% in Oregon. So there's a pretty big gap between U6 and U3 unemployment numbers. Now, the labor force participation rate, as you see on the right, has seen a significant decline since its peak in the late 90s. And it's projected to continue to fall. Many economists believe that the labor force participation rate will be below 60% by the year 2020, as more of the baby boomer generation moves into retirement and added the labor force. So what's that mean? I think that has some pretty significant social and political ramifications if we have 60% or less of the people essentially carrying the water for the rest of the country. I also think that our unemployment rate, although it continues to fall, I think it's more of a function of the labor force, the denominator, getting smaller than it is that actual jobs being created and more employment in the country. Just some observations to keep an eye on, I think. Back to interest rates. This is a picture of the U.S. prime rate going back to 1979. The U.S. prime lending rate has been at 3.25% since 2008, the lowest rate since the 1950s. Since 1947, the average prime rate is 9.84%, the median is 8.75%, and the mode or most frequent is 7.5%. You'll see the highest prime rate back there in 1980 was 21.5%. There may be some people that remember when rates were like that. And if you consider a commercial real estate investment when prime rate is at 7.5%, 8%, you're probably going to pay 9.5% for that commercial real estate investment. Makes a big difference on property values. Here's just a quick look at the yield curve. Again, Fed monetary policy is keeping short-term rates very low, but we are starting to see the longer-term rates start to bump up a little bit. The blue line was just as of the 14th of this month, and the yellow line is this time last year. Business confidence. The National Federation of Independent Businesses publishes a monthly business optimism index based on 10 survey indicators that they send out to their members. And this is just sort of a good relative look at where business confidence lies. And you can see that optimism bottomed out in 2009, but has been steadily improving, although it's still below pre-recession levels. It looks a lot like that business earnings graph. I don't think that's a coincidence. As part of that survey, data is collected for the reasons businesses cited for their expansion outlook. Economic conditions remain in the top reasons cited for businesses not expanding, followed by political climate, which includes uncertainty about taxes, healthcare costs, regulation, etc. I talked a little bit about businesses deleveraging. While the businesses were pretty successful in deleveraging, consumers have not been so successful. As of January 2014, the average U.S. household has credit card debt of $15,000, mortgage debt of about $150,000, and student loan debt of $32,000. And the average credit card's $681. Now there's some mortgage lenders here in the room that will tell you that once credit scores get below 740, borrowers start paying a premium for those loans. And if your credit score is below 680, we start having a hard time getting approvals done. So 681 is not a very good average credit score. In total, American consumers owe $11.36 trillion in debt, which is down just a very slight fraction from last year. $857 billion in credit card debt. $793 trillion in mortgages out there. And $1.15 trillion in student loans. Let's talk a little bit more about student loans. It was June 2010 when total student loan debt surpassed total credit card debt for the very first time. This enormous debt is really a threat to our economy going forward, I believe. The Federal Reserve Bank recently released a study of how the younger generation is being strangled by student loans. The study found that 43% of 25-year-olds had student debt in 2012, and that's up from just 27% in 2004. Now, this debt is absorbing funds that are now no longer available to buy homes, buy cars, save for retirement, all of these things that are certainly important for our economy. Consider also that 17% of these student borrowers are now 90 days or more past due on their obligations. Now, at the very height of the real estate crisis and crash, borrowers, we had delinquent mortgage loans were well under 10% of the country. Nowhere near as troubled as the student loan debt. So what does all this mean for you? The economy is recovering. I think the new economy is going to be different than the old economy. I think our labor force is changing, technology is changing. Keep an eye on the Federal Reserve Bank. The Fed is largely financing our recovery through bond purchases. And when they stop purchasing or start shrinking the size of the Fed and selling off assets, interest rates are going to go up, inflation is going to go up, our economy will look a lot different. Take advantage of today's low-rate environment and abundance of capital. Fix rates for as long as possible. Plan for inflation and a higher cost of capital. Index those leases to CPI or something of that nature. Clean up your own balance sheets. Pay off that credit card debt. Help your kids graduate debt-free. They are going to be vital to our economy's future. We need them in the labor force. We need them buying houses. We need them buying cars to keep our economy moving forward. Support your local community. Shop and do business locally with your friends and neighbors. And don't go at it alone. Develop relationships with your bankers, attorneys, accountants, and realtors. Finally, I'll leave you with one of my favorite quotes from Winston Churchill. What I love about Americans is that after they have exhausted every other alternative, they always seem to do the right thing. So I think that's very appropriate. So thank you all very much.